Picture a man named David. He's in his early 40s. He drives a used car, brings lunch to work, skips the vacation his wife suggested, and checks his bank balance every Sunday morning before the rest of the house wakes up. He is, by every standard definition of the word, responsible. Over the last decade, David has saved roughly $80,000. He keeps it in a savings account at a major bank safe, liquid, untouched. He sleeps well at night knowing it's there. What David doesn't know, what almost no one sits down and tells him, is that while he was being responsible, that $80,000 was quietly, mathematically being dismantled. Not stolen, not lost, just slowly, invisibly reduced in its power to do anything meaningful in his life. This is not a story about bad habits. It is a story about a belief so deeply embedded in modern culture that questioning it feels almost irresponsible. The belief that saving money, putting it away, keeping it safe, letting it sit, is one of the most financially sound things a person can do. What the evidence actually suggests is far more unsettling than most people are prepared to hear. To understand what is actually happening to money while it sits still, you have to understand the single most important and least discussed force in personal finance. Not interest rates, not stock markets, inflation. Most people know the word. Very few actually understand what it does over time. Inflation is not simply prices going up. It is the systematic reduction in what your money can purchase. Every dollar you hold loses a portion of its purchasing power every single year. And that erosion compounds, just like interest, except in the wrong direction. Here is a simple illustration. In the early 1990s, a middle-class family in the United States could buy a modest home for around $100,000 in many parts of the country. By the early 2020s, that same home in the same location often cost 3 to 4 times more. The money didn't change. The home didn't become 3 times better. What changed was the purchasing power of the currency itself. The dollars became worth less, gradually, year after year, while the assets denominated in those dollars increased in price. The U.S. Federal Reserve historically targets an inflation rate of around 2% per year. That sounds modest, almost harmless. But at 2% annual inflation, your money loses nearly 18% of its value in a decade. Over 20 years, it loses over a third. Over 30 years, the span of a working career. The purchasing power of a dollar held in cash falls by roughly half, if not more. And that's at the Fed's target rate. Between 2021 and 2023, inflation in the United States and across much of Europe ran significantly above that, reaching highs of 8 to 9% in some periods. 1 year of 8% inflation does more damage to savings than 4 or 5 years of the Fed's target rate combined. Now consider what most savings accounts actually pay. As of the mid-2020s, the average interest rate on a standard savings account at a major U.S. bank hovered around 0.5% to 0.6%, sometimes lower. High-yield savings accounts at online banks offered more, sometimes between 4 and 5%, but those rates fluctuate with Federal Reserve policy and are not guaranteed to remain elevated. So here is the arithmetic that almost no one does, but everyone should. If your savings account earns 0.5% per year and inflation runs at 3%, your money is losing 2.5% of its real value annually. You are not growing. You are shrinking slowly, quietly, in a way that shows up as a loss on your bank statement. The number goes up. The power behind that number goes down. This is what economists call a negative real interest rate, and it is not some exotic financial condition. For millions of savers, it has been the standard reality for most of the last 2 decades. David, the man with $80,000 in his savings account, is not saving. He is donating purchasing power to the broader economy, one invisible percentage point at a time. The deeper question is why this happens. Why does the system work this way? Why would anyone design a financial architecture in which responsible savers are quietly penalized? The answer lies in how modern economies actually function. And it reveals something about the relationship between money, banks, governments, and citizens that most people were never taught to see clearly. When a central bank sets interest rates low, it is making a deliberate policy choice. Low rates make borrowing cheap. Cheap borrowing encourages businesses to expand, consumers to spend, and governments to finance operations at reduced cost. The economy, in theory, stays active and productive. But low rates also mean that holding cash earns almost nothing. The policy, whether intentionally or not, punishes savers and rewards those who borrow, invest, and take risk. This is not a conspiracy. It is an incentive structure. And like all incentive structures, it produces predictable behavior. The people who understand it move their money into assets, real estate, stocks, businesses, commodities that tend to preserve or grow value in inflationary environments. The people who don't understand it leave their money in savings accounts and slowly fall behind. The result, over time, is a financial gap that has little to do with income and almost everything to do with financial literacy. Two people can earn the same salary, live in the same neighborhood, and work at the same company. If one of them understands the mechanics of inflation and the other does not, their financial outcomes over 20 years can diverge by hundreds of thousands of dollars. Not because of anything they actively did or didn't do, but simply because of where they chose to store the value they created through their labor. Here is where it becomes even more revealing. The assets that protect against inflation, the ones the financially informed tend to own, are not exotic or difficult to access. They are the most ordinary things in the world: a house, a diversified portfolio of stocks, a small business. These are not speculative bets reserved for the wealthy. They are, historically, the standard vehicles through which the middle class builds and preserves wealth. Take the U.S. stock market as a reference point. Over the last 100 years, the S&P 500 has delivered an average annualized return of approximately 10% before adjusting for inflation, roughly 7% after inflation. That is not a guarantee. There are years, sometimes clusters of years, where the market falls sharply. But across long time horizons, the evidence is remarkably consistent. Money invested broadly in productive companies tends to grow significantly faster than inflation. Money held in a savings account does not. To make this tangible, $10,000 invested in a low-cost index fund tracking the S&P 500 in the year 2000 would have grown to over $60,000 by 2023, even accounting for the catastrophic crashes of 2000-2002 and 2008-2009. The same $10,000 left in a savings account earning average rates over the same period would be worth perhaps $12,000 to $14,000 in nominal terms, and significantly less in real purchasing power after inflation. The difference is not skill. It is not timing. It is simply the decision of where the money lived. But this raises an uncomfortable question. If the math is this clear, why do so many people continue to save in the traditional sense? Why does the habit persist, generation after generation, even as the evidence against it accumulates? The answer is psychology, and it is more powerful than any spreadsheet. Human beings are wired, through millions of years of evolution, to avoid loss. Behavioral economists call this loss aversion. Losing 100 produces roughly twice the emotional pain of gaining 100 produces pleasure. This asymmetry shapes how we perceive financial risk in ways that are deeply irrational but entirely predictable. A savings account feels safe because the number never goes down. You never open your bank app and see your balance reduced. You are never confronted with a statement that shows a loss. The slow erosion of purchasing power is invisible. It doesn't show up in the interface. The cognitive experience of holding money in a savings account is one of complete security. Investing in stocks or real estate feels risky because the numbers do go down, sometimes dramatically, suddenly, and publicly. In 2020, during the early weeks of the COVID-19 pandemic, the S&P 500 fell by roughly 34% in just over a month. That is terrifying to watch in real time, even if, in retrospect, it was one of the greatest buying opportunities in a generation. The market recovered fully within months and went on to reach record highs. The person who kept their money in savings during that period never experienced the panic of watching their balance fall by a third. But they also never experienced the recovery. They simply drifted downward, invisibly, against the current of inflation, feeling entirely safe the whole time. There is another dimension to this that rarely gets discussed: the compounding effect. One of the most celebrated principles in personal finance works with equal ferocity in both directions. Most people hear about compounding in the context of investing, your returns, which earn returns, and over time, the growth becomes exponential. Einstein allegedly called it the eighth wonder of the world. Whether or not he actually said that, the math is real, but inflation compounds too. The 3% purchasing power you lose this year is applied to a base that is already smaller than it was the year before. Over a 20-year period, the compounding effect of inflation on idle savings is not 60%. It is closer to 80%. The harm accelerates over time in exactly the same way that investment gains accelerate over time. Waiting longer to act does not reduce the problem. It magnifies it. And here is the cruelest part. The people who are most diligently saving, who are sacrificing consumption now to create security later, are being penalized by the very system they are trusting to protect them. The person who spends impulsively today loses money the obvious way. The person who saves responsibly loses it the invisible way. Both arrive at the same destination, but one of them feels virtuous the entire journey. This is also a story about who benefits from widespread financial passivity. When millions of savers deposit money at a bank earning 0.5%, the bank takes that money and lends it out at 7%, 15%, or even 25% in the case of credit card debt. The spread between what the bank pays depositors and what it charges borrowers is one of the most reliable profit margins in the history of commerce. It is called the net interest margin, and for the largest financial institutions, it generates billions of dollars in annual profit. The savings account is not a gift the bank offers its customers. It is a product the bank offers itself. Your patience and your passivity are the raw material. Every dollar you leave in a savings account for a decade is a dollar that the bank intermediates, lends, and earns a return on and shares only the smallest fraction of that return with you. This is not an accusation. It is a mechanism. Banks are not villains. They are entities operating within an incentive structure that rewards them for gathering and deploying capital. The problem is asymmetric information. The bank understands this mechanism perfectly. Most depositors do not. And the gap between those two states of understanding is where the value transfer happens. Real estate tells a similar story from a different angle. Over the last 5 decades in most developed economies, residential real estate has dramatically outpaced inflation. In cities like New York, London, Sydney, and Vancouver, property values have increased by multiples that bear almost no relationship to wages or consumer prices. Someone who purchased a home in a major metropolitan area in the 1980s and simply held it has not merely preserved their wealth. They have often multiplied it by factors of 5, 10, or more. The person who rented the apartment next door for the same 40 years paid for the landlord's mortgage, the landlord's maintenance costs, the landlord's property taxes, and handed the landlord the equity gain as a bonus on top. The renter was not foolish. The renter was simply positioned differently within a system that rewards ownership of assets and gradually erodes the position of those who hold only currency. This is not to say that renting is always worse than buying. Markets differ. Timing matters. Individual circumstances vary enormously, but the broad pattern, across decades and across countries, is consistent. Currency depreciates, productive assets, over long periods, tend to appreciate. The person who holds the asset captures the appreciation. The person who holds the cash subsidizes it. None of this means that saving money is useless. An emergency fund is not a luxury. It is a necessity. 3 to 6 months of expenses held in liquid, accessible form is a financial safety net with no adequate substitute. Without it, a single unexpected event, a medical crisis, a job loss, a car breakdown, can force someone to liquidate long-term investments at exactly the wrong moment, or to take on high-interest debt that compounds against them for years. The distinction that matters is between saving with purpose and saving as a permanent strategy. The first is rational. The second, maintained indefinitely, is self-defeating. The error most people make is treating savings as a destination rather than a staging point. Money accumulates in the account feels secure, and the decision of what to do with the surplus gets deferred. 1 month, 1 year, 1 decade. The inertia of the savings account is its most dangerous feature. It asks nothing of you. It creates no discomfort. It produces no obvious failure. It simply holds your money in place, while the world around it slowly renders it less powerful. There is a concept in economics called opportunity cost. It refers not to what you lose directly, but to what you fail to gain by choosing one option over another. Every dollar sitting in a low-yield savings account has an opportunity cost equal to what that dollar could have earned if deployed differently. That cost is never visible on any statement. It never triggers an alert. It never gets reported to the IRS. But it is real, and over a working lifetime, the accumulated opportunity cost of financial passivity can equal or exceed the total amount of money a person earns from their job. That is the part that never gets taught. Not in schools, not in most households, not in the cultural stories about money that get passed down through generations. Work hard. Spend less than you earn. Put the rest in the bank. That framework, delivered as wisdom, is approximately half true, and the missing half is expensive. The world's most successful long-term investors, Warren Buffett, Charlie Munger, the endowment managers at institutions like Yale and Harvard, share a perspective on cash that is almost exactly the opposite of conventional wisdom. They treat cash as a temporary condition, a bridge, something you hold while you wait for a better place to put it, and then you put it there. Buffett has written extensively in his annual letters to Berkshire Hathaway shareholders about the corrosive effects of inflation on purchasing power, and about the fundamental difference between a productive asset and a currency-denominated claim. The Yale Endowment, under the direction of David Swensen for nearly 3 decades, famously maintained an extremely low allocation to traditional cash and fixed income. The bulk of its portfolio was invested in private equity, real estate, hedge funds, and equities, assets with real productive capacity. The endowment's long-term performance dramatically outpaced conventional portfolios built around the traditional model of cash and bonds. Swensen's work is publicly documented, and his frameworks have been analyzed extensively in financial literature. The principle is not secret. It is simply not widely practiced. David is still sitting at his kitchen table on Sunday mornings, checking his balance. The number is higher than it was last year. It will probably be higher still next year. But the house he could have bought 5 years ago with that money now costs 40% more. The index fund he could have invested in has nearly doubled. The purchasing power of his $80,000 is quietly, consistently, invisibly less than it was the day he started accumulating it. He feels responsible. He feels prepared. He is, by every measure he can see, doing the right thing. What no one told David, and what this system has little incentive to tell him, is that safety and growth are not the same thing, and that choosing safety at the expense of growth across long enough periods of time is its own form of financial risk. A risk with no alarm, a risk with no visible loss, a risk that feels every single day like the right decision. The most dangerous financial traps in the modern world are not the obvious ones. They are not the scammers, the predatory lenders, the get-rich schemes. Those are visible. You can learn to recognize them. The most dangerous trap is the one that looks exactly like a virtue, the one that rewards discipline and patience by quietly, patiently, methodically making you poorer than you otherwise would have been. Money is not a static object. It is a living force in a living economy, and it behaves exactly like everything else in a living system. Hold it still long enough, and it begins to decay. Not all at once, not dramatically, just slowly, every year, one invisible percentage point at a time, until one day, the responsible man at the kitchen table realizes that 30 years of discipline have left him exactly where he started, in a world that costs twice as much to live in. The question was never whether to save. The question was always, save it from what? If you're enjoying the video, don't forget to subscribe for more.